Given the turbulent nature of today's investment markets and that the stock and bond markets are struggling, how should portfolios be positioned today to reduce volatility and take advantage of opportunities to enhance long-term returns? Today I'm interviewing Andrew Altfest, the president of Altfest Personal Wealth Management, to find out Altfest's outlook on the markets and the economy, learn why Altfest thinks managing risk in one's portfolio is now more important than ever, and to identify what types of investments we find attractive in today's environment and why. Hi everyone, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides investing and personal financial planning insights to help physicians achieve their key financial and life goals. Before I bring in Andrew, a little background about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while acting as a legal fiduciary always putting the physician's best interests first. As physicians, you probably would also like to know that Altfest is the preferred wealth manager for members of the Medical Society of the State of New York and the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, just to name a few of Altfest's physician association relationships. As I mentioned, we're very happy to have on the channel today Andrew Altfest, the president of Altfest Personal Wealth Management. Andrew, among his many roles at the firm, is a key member of Altfest's Investment Leadership Committee, where he plays a major role in setting investment strategy and choosing investments for client portfolios. Andrew is also a CFP and an MBA from Columbia University. This is the first of two videos with Andrew Altfest on how Altfest is positioning client portfolios during the current turbulence in the stock and bond markets. So Andrew, thank you very much for being with us today on Wealth Matters for Physicians.
It's my pleasure, Mike. We've worked together for over 19 years now. We've had a lot of fun doing it, and it's my pleasure to be a guest, and I think this is going to be a good conversation.
I think so. I think our physician audience is really going to like it. So before we start talking about portfolio positioning, could you paint us a little picture of the current state of the economy and the markets?
Yeah, so let's talk about recent history. During COVID, when COVID struck, the government really stepped in, and there was so much stimulus provided. There was helicopter money. There was the PPP loan program. There was unemployment benefits, which were extended. And then, of course, monetary policy. So interest rates went down to nothing. The Fed doubled its balance sheet overnight. And so the good times were provided because, after all, people were having major difficulty at that time.
Right.
And that's been a great backdrop to the economy. The economy, there was a huge amount of pent-up demand, and supply had been cut significantly. And so where we are today is we've had this perfect storm that's caused inflation to rear its ugly head for the first time in decades. And so we've had, if you just take a look at the airline industry, for example, people weren't flying planes, right? And so the airlines downsized. Now travel has come way back
through the roof.
Yeah, but where are the people to fly the plane? So it's the supply hasn't been there to meet the demand, and that's caused inflation. And the job market is really strong. We've had problems abroad with Russia and Ukraine. That's caused oil prices to accelerate, food prices to be higher. So we've had this perfect storm that's caused inflation to move up. And now the Fed is having to reverse course and slow the economy down to fight inflation. So we see the Fed reducing its balance sheet, increasing interest rates, and we're starting to see the economy slowing. And we're concerned today that we're going to be in recession if we're not already in recession as we speak.
So given that scenario, given the current state of affairs, what would you say is Altfest's current economic and market outlook over the next several months?
Yeah, I think a lot's going to depend on how successful the Fed is at at reducing inflation while not choking the economy to the point that we're in recession.
Right.
So there's a lot of unknowns. Our view is that that's very difficult to do, that a recession is very likely, and as a result, we are defensively positioned. And so we're positioned in companies that are less cyclical in nature, that their businesses are less tied to the economy, for example, at healthcare. And we're also taking money out of traditional stocks and bonds and putting it into alternatives, into companies that first can behave differently than stocks and bonds, and second, that could do well in a higher inflationary environment. We could talk more about what those companies are.
Yes, we'll be talking more about alternatives in a little bit. So Andrew, why do you think it's so important right now to be focusing on managing risk well in one's portfolio?
Yeah, but when interest rates are next to nothing and the Fed is providing so much support and the federal government is providing support as well, you can own stocks, bonds. It's great times, right? You can just invest in everything. Now, when the punch bowl is being taken away and we're having interest rates increase, it's a challenge to both stocks and to bonds, because bond investors will sell the current bonds that they own to invest in higher yielding bonds that are being issued. And stock investors have more of a appetite to move out of stocks and own bonds, because now you have extra yield. And there are other reasons, technical reasons, why higher interest rates are bad for stocks. So you need to think about how to manage risk in this environment, an environment in which interest rates are moving up because inflation is higher. And so you have to think about non-traditional investments, to think about investments like real estate, infrastructure investments, and just in general investments that can be more opportunistic than just owning stocks and bonds. For example, we have a strategy, I think we're going to talk a little bit more about that, called the Alternative Alpha Portfolio, in which we can be very tactical. We can even short stocks, so bet against parts of the market that we feel are going to decline, and just in general reduce the risks out there. I think that is how you have to manage risk today.
So Andrew, you said that Altfest currently likes healthcare stocks. Can you tell us a little bit more about why healthcare stocks are appealing right now?
Yeah, at Altfest, we're contrarian thinkers. We like to think for ourselves, not just invest in the stocks that are the most popular, but in stocks that represent good value. And if there's a reason to invest in things that haven't done as well, then we'll do that. Now, healthcare stocks are, first of all, they're less cyclical in nature. People always need healthcare, right? It's not something where you can say, the economy is bad, so I'm not going to be a consumer of healthcare goods. So healthcare is less cyclical, and it's behaved that way this year. It's been more defensive as the markets have declined. The second reason that we like healthcare is because it's more reasonably priced. The valuations are more reasonable. If you take a look at it, there's a great statistic now. There's almost as many companies today that are selling for below the amount of cash on their balance sheets as there was during the financial crisis. And the financial crisis being a great time in retrospect to own stocks and being a purchaser of stocks. So if you take a look at what companies those are that are selling for below the cash on their balance sheet, there are a lot of biotech companies. And so it's been a challenging time to be an investor in biotech, and therefore we see opportunities to buy companies that the market is discounting the value of their business if it's selling below the cash it has. So these are signs that it can be a good time to own healthcare investments. It's an outsized position in portfolios today for us. We love the defensive nature of it, and we also are comfortable with the prices that we're paying for those companies.
That's great. And when you say that there are many companies right now that are selling for less than the cash that they have on their balance sheet, just to emphasize the point, it's basically you're getting the company for free.
Right.
Amazing. That's amazing. So what is Altfest's thinking about international stocks at the moment?
Yeah, we like international. If you take a look at international stocks, they are selling at well below the averages compared to where they historically have sold compared to the U.S. stock market. And so you can buy international stocks at steep discounts. And so we think that that is going to reverse itself over time. We are not buying all international stocks. We're selective where we're buying. We like developing markets today. And in particular, we like developing Asia and China. The Chinese stock market over the last year and a half has been a laggard, and there are many reasons for that. There's been a regulatory crackdown by the Chinese government.
Right.
They're struggling today with COVID and getting that under control. They have a zero COVID policy today.
Mm-hmm.
They've had a hard time vaccinating the elderly, and they have old, outdated vaccine technologies that they're using. However, they're starting to. We think they can get beyond those problems, and second, they're starting to reverse course with the regulations that they've imposed because it's really choked the stock market. Now, the Chinese stock market is you can get growing companies at value prices there right now, and there's a long-term secular growth story. You have a growing middle class, and the Chinese stock market, contrary to what you might believe, their earnings of the stock market are set to exceed the earnings of the U.S. stock market this year. But you're able to buy companies in that market, particularly consumer and technology companies, at very attractive prices. So we have long-term growth story, attractive prices, we have some diversification because what is going to happen in China and how China is going to perform can be very less related to the U.S. stock market. So we like it for many reasons, and it is a prominent part of portfolios today, not as much as U.S. stocks, of course, but it is there as an allocation, and we think it's going to do well over time.
Thank you. That's excellent. And changing to another, type of asset. In 2021, we were having a hard time finding quality municipal bonds at rates that we found, at yields that we found attractive. What is your thought currently on municipal bonds now, and how are you finding things when you're searching in the market?
It's actually bond market's like the Wild West, and you can have fun in that market. It's owned by individual investors, and when times are not good, individual investors sell. They're throwing those bonds off a truck, and so you can scoop them up at deep discounts. And what happened last year was the tax-free bond market was not attractive. You had historically low yields relative to taxable. So if I'm a high-earning physician and I am looking at buying bonds, I'm going to say, well, what are these bonds yielding to me after adjusting for my taxes, my tax bracket?
Right.
And if it's compelling, well, I'll buy tax-free bonds. That's what we do for our physician clients. But if it's not compelling, because the yields are so low on the tax-free bonds, then we'll avoid them, right? And that's what we were doing last year. We were on strike from tax-free bonds.
Taking a strike.
Yes. Now, the tax-free bond market has changed because there's been panic in the bond market in general. Bonds are down 10% this year.
Right.
And so there's been a lot of selling and of money moving out of tax-free bond funds and selling of individual bonds. And so now, while the tax-free bond market isn't a screaming buy, that's not what's happening at the moment. There are more opportunities these days, and it does make sense for higher earning physicians to own tax-free bonds. And so we're spending a lot of our time purchasing tax-free bonds for select clients who it makes sense for.
Thank you. If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or retirement ready analysis, or discuss any of your other personal financial planning areas with an Altfest professional at absolutely no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video and would like to get notifications when we upload new videos, please remember to click the subscribe button and to smash the bell icon below. If you think that a fellow physician would find this video interesting or helpful, please share it with him or her to help them get their finances optimized. Lastly, as always, this is channels for you, and we want to make it as helpful and as enjoyable as possible. If you have any topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So just please share your comments in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and remember to keep on optimizing your finances, or let us help you if you'd like.